Hi everyone, welcome back to the channel Yong. It has been quite a number of years since I started working and going through some ups and downs in my career and life. I could observe there are mistakes made in some financial decisions by myself and also by the people around me. In this video, just to list down a few of the dumb financial mistakes that we could all avoid. First mistake to avoid is saving all incomes in the saving account with very little return. The school never taught me how to manage income and expenses from a personal level, although has been studying accounting for many years. As a young adult that first started working 10 years ago, I unconsciously doing what my family is doing, being a saver rather than a spender. But I also do not know what I should be doing with my savings. For a person with no family commitment, I don't need to feed a child, and having no home mortgage. My parents and I don't own any house back then. It is not an issue to save. Having savings definitely offer the feeling of financial security, but it is not so motivational when I see the money remain about the same after a year because it does not grow in the savings account. As we know, savings account offer very little and insignificant interest rate to the savers. The interest rate is less than 1%. In most recent months, my saving account is crediting only 60 cents to me. In a year, it can total up to $7. Still not very attractive. If I were to tell my younger self, I would say, thumbs up for having emergency fund. But please do not keep all savings in the savings account. The return is not even on par with the inflation rate. And eventually, the money value is shrinking, so do our purchasing power become smaller. Second mistake to avoid is not setting a clear investment goal and horizon. There are many types of financial products in the market offered by the banks, brokerage account, or even from our friends and family. But most of the time, we started to buy these products without truly understand the product features, whether they fit in our investment goals and horizon or not, because we ourselves do not have a clear goal. Knowing that saving accounts rate is not attractive, I started to keep savings in fixed deposit that offer interest rate up to 4%, which is the next best choice. And after that, what can be the other options? So there was the time I got a lot of exposures. It is good, but without a clear investment goal and horizon, I feel a bit lost in the journey. Back then, when I do not have a target to buy a house or seeing myself savings for retirement, which is too far away, I still put aside some extra cash for insurance saving plan, unit trust, meme stock, and blue chip stock. At the end, I'm not able to commit to the 30 years plan when I move to overseas, and also selling some of the stocks at a loss when I am unemployed. The contributing factors is that I did not set a clear goal of investment, and that's why it is easy for me to pull out when I feel insecure. Even though I understand the stock is undervalued at the time I'm buying, but when seeing the price drop, I also feel that my heartbeat is dropping and thinking of selling to stop loss. But then, in the next few days, the price is up again. In short term, investment is an emotional game, but in the long term, it is a wealth progression journey if we are able to commit the investment horizon. It is extremely important to have a clear goal before investing. For example, we are investing to beat the inflation rate in 2 to 3 years' time. We are investing to get some decent return while saving for the house down payment in less than 5 years, and savings for retirement, which we have a horizon of over 20 years. Apparently, if we have a clear goal, it is no longer emotional to see the price fluctuation and less likely to sell at a loss. To avoid repeating mistakes, start setting clear investment goal or goals. Knowing our own risk appetite, target return, horizon, it is much more easier to commit. I do observe some of the mistakes that people around me are making, such as spending more than earnings and going into debts, and unable to manage the debt properly, which are the red flags to create more financial problems in the near future. The third mistake to avoid is spending more than what we earn. This may link to the spending habits like buying unnecessary items, buying luxurious products, going to over-budget trips, spending for big wedding, or buying a bigger house than we need. All these are trigger points that we may end up paying more out of the pocket and eventually result back to no savings or even going into debts. If we have predictable income, we should also have predictable expenses. Trying to match the budget, always spend within our means, from daily shopping up to buying big ticket purchase in life. It requires us to be rational rather than being emotional. Think about what we really need and what we can afford. That's the right mindset to start. The fourth mistake to avoid is not paying debts on time. There are good debts and bad debts, just that we need to manage both of them at the same time. Debts can mean credit card bills, student loan, personal loan, car loans, and housing loans. Having debts is fine. The issue is not paying the debts on time, which incur much higher interest expenses for penalty and default. For example, credit card is the easiest money to spend. It is unsecured loan offered by the banks, and that's why its interest rate can be as high as 26 to 28% per annum. Credit card is very helpful as it reflects our credit habits to the banks, our lenders. At the same time, if we have spent the money and we do not pay the outstanding amount to our lenders, we have to pay the interest to them. Let's say for the $1,000 amount, the interest charge may be around $20 for the month. It does not sound a lot to pay, but the interest rate here we're referring is actually very high, which is 26 to 28% compared to the housing loan rate at 4%, also compared to what we are getting from our savings account of less than 1%. Not paying debts on time can affect our credit score. The problem is real when we want to apply for loans in the future. A person with bad credit rating is unlikely to get additional loans or unable to refinance existing home loan when there is lower interest rate, or just unable to get better interest rate of loans compared to the people with good credit score. So remember to avoid this mistake if you would like to make use of credit lines for yourself in the future. Well, these are just some of the mistakes. It is easier said than do, and it is never too late to start planning and executing. Set a clear goal for yourself and keep learning and reflecting on how we can do better in our next steps. Do comment below to share your views on this. I hope you enjoyed the video and we shall discuss more in the next one. Thank you for watching. Do consider subscribe to our channel for more content like this. Thank you.